November 2015. Yeah, let's do November 2015, question 3. November 2015, question 3. So we start with part A. Part A of the question, you are told that compare and contrast the relative merit of the direct method and the indirect method of presentation of the statement of cash flow. Yeah, we have the indirect method and the direct method. Which one is the easiest? Yes. In case of presentation, the indirect is there, but in terms of interpretation, the direct method is the most relevant. You see, we say that an indirect method, when you are dealing with operating cash flows, usually shows the cash received, cash paid. So in this case, you are able to determine or to separate between the cash flow, cash received and the cash paid, which becomes easier for you to explain to other stakeholders as compared with the indirect method. Now, under indirect method, we say that under operating, you take the profit after, profit before tax, then you go to the adjustment. So can you explain to an accountant what are those adjustments? That depreciation, you add back, investment income, you deduct, gain on disposal. It becomes very complicated to explain to them. Are you together? But when you're having a direct method, just show them the cash received, cash paid. Also, when using the direct method can use also, because in this case, you can be able to determine the cash received as well as the cash paid. Therefore, you can do what we call the cost forecasting. You can be able to prepare the budget from the direct method, but you cannot from what? The indirect method. Are you together? The only advantage of indirect method is that you are able to convert the cash flow from the accrual basis to cash basis, because we say that we deal with actual cash inflow, actual cash. For example, when you are preparing the tax account, we have to consider the balance at the beginning, balance at the end, plus what was charged in the income statement. Now, this what we charge in the income statement is what goes to the income statement using the accrual basis. But to the cash flow, don't show what we are supposed to pay. You usually show how much do we usually paid. Are you together? How much do we paid in that case? So in this case, you have to show the tax pay. So you're saying that under direct method or indirect method, you're able to convert the cash flow from the accrual basis to cash basis. Nothing to write, just understand that. So, cool, let's go to part B. Mawingu Group has prepared the following financial statement for the year ended that 1st October 2014 and that 1st December 2015. So we have the income statement, we have the balance sheet, and we have the additional information. Let's go to the additional information. Additional information. So under the additional information, you are told that some item of machinery with an original cost of 68 million and a net book value of 360 was sold to for 256 million during the year ended that 1st October 2015. We had a disposal. Now my question is, was it disposed at a gain or a loss? There is a loss on disposal. Yeah, loss on disposal. We had an item of machinery with a net book value of 360, but we only sold it at 250. So you take 256, that's what you received, but the net book value of 360. Good. 250. There was a loss of how much? Sorry? 104. That's the loss on disposal. If you have a loss on disposal, that's affect the PPE account. So let's open PPE account. Then, see number one, let's continue. The following information related to PPE. We have the cost, depreciation, and net book value. There is a point we said when I was doing a similar question in class. What did I say? Whenever you are given the PPE breakdown, the additional information for both the cost and depreciation, how do you adjust this account? Yes? Yeah. In this case, the PPE account, you show them at cost, and then you prepare the depreciation account separately. In short, you don't show the PPE at their net book value. Are you together? So PPE is an asset, so we determine the balance brought down, balance carried down. Depreciation is an expense, so we'll be having balance brought down, balance carried down. Note number one. How much was the cost? Opening balance? Yeah, the opening balance was 5,800, and the closing balance 4,800. No, it's the opposite. Eh? Yeah, it's the other way around. So the opening is 48, and the closing we have is 58. What about depreciation? 23, 2320, and the closing balance was 2720. Then we go back to note number one. Some item machinery with an original cost of 680. So from the PPE, we had a disposal. So disposal, and you record that its original cost, which was 680. Then to the depreciation account, on the debit side, we had a disposal. How much was the depreciation date of disposal? This item had a cost of 680 and a net book value of 360. So that means how much was accumulated depreciation at the date of disposal? 320. Good. Number two. During the year ended that 1st October 2015, Mawigu Group acquired, so this is a case of acquisition, 80% of share capital of Mwewe Limited. The net asset of Mwewe Limited was follows at the date of acquisition. So we have property, plant and equipment, inventories, trade receivables. Then under liability, there was debentures, trade payable, bank balance, taxation. And the net asset acquired was how much? 400. That's the net asset acquired. Eh? Number three, the cost of PPE of Mwewe Limited on the date of acquisition was how much? 800. So now let's be here. We acquired Mwewe, another subsidiary, of which had an asset which had cost how much? 800. So in the PPE account, you debit Mwewe an amount of 800. I have you told that the cost of PPE on Mwewe Limited on the date of acquisition was 800 million, and the accumulated depreciation was 320. So where you have the balance brought down, you add Mwewe. Came with a depreciation of how much? 320. If you take 800 minus 320, you get? Is that 480? Yes, and that's what you are given note number 2 as the net book value. Then you're told that still number 3. During the year ended that 1st October 2015, there was a revaluation gain of 80 million attributable to the holding company PPE. Revaluation increases the value of the asset. Therefore, to the PPE account, you show what? Revaluation. An amount of 80. Good. Number 4. The other investment was sold for 240 during the year. Other investment. Let's go to the non-current assets. Let's go to the non-current assets. Under the non-current assets, we have investment. And the investment you have in associate company, and we have other investment. How much was the opening balance? 200. How much was the closing balance? Because we disposed. So that means the net book value was 200. Now let's go back to note number 4. Note number 4. The other investment was sold for 240. Now the question is, was it a disposal gain or a disposal loss? Was a gain. 240 minus 250, there was a gain of? Yes, let me write it somewhere. Gain 240 minus 200, there was a gain of 40. Good. Number 5. The total purchase price of 80% shareholding of Moe Limited was 360. Tuachie hapo. We say that if you acquire another business as a going concern, the difference between the purchase consideration and the net asset acquired is what? Good. Can you even compute the goodwill? And the goodwill, the purchase consideration of Moe was how much? 360. You raise net asset acquired. Note number 2. How much is the net asset acquired? 400, but you only acquired 80 per. Yeah, you take 80% of 40 or 400, then 360 minus that. The difference between the two goes to the goodwill. An amount of 40. That means our goodwill increased by 40. We go back to note number 5. The total purchase price of 80% shareholding in Moe Limited was 360 million, which was paid by issuing 80 million worth of share at par value, with the balance being paid in. So remember, we said that under investing activities, we have acquisition of subsidiary, net of cash acquired. So we look at acquisition. We want to determine how much do we really pay Moe. Acquisition of Moe, net of cash acquired. We acquired Moe for how much? 360, right together? Okay, let me just write purchase consideration was 360, of which the 360 was paid now in two perspectives. Number 1, we paid through the issue of ordinary shares. What? How much? 80. And the balance was paid in cash. How much was the value of the cash? 360 minus that one, you get to 280, eh? 280. Are you together? Now let's do that statement again. The total purchase price of 80% shareholding in Moe Limited was 360 million, which was paid by issuing 80 million worth of share at par, with the balance being paid in cash. So this is what we paid. Now, but in this case, we are not looking at the acquisition of Moe. We are looking at net of cash acquired. Let's go to number 2. Did we acquire Moe with any cash or the bank balance? Note number 2. We had a bank balance. That's bank overdraft. Right together? Yes, we paid him 280, but we took over the bank overdraft we have to pay. Do we add? Do we less? We add. We purchase the bank over. We have to pay that. An amount of how much? So you add bank overdraft of 80. It goes back to how much? What? Yeah, that means we paid more than what we think we usually really paid. We really paid. Good. Is it okay now? Good. I think now we can close what we already have opened. This side is more. 58, you add that, you get 6480. 6480. Give me the balancing figure. 800. It's on the debit side. If the asset is on the balance sheet on the debit side, that means there was an increase in PP. What can make your PP to increase? Good. Acquisition. Acquisition of the purchase. It's not devaluation because we have already captured the devaluation. Now let's go to depreciation. That will be 3040, right? 3040 minus that 400, right? Yeah, that's the depreciation charge for the year. This is what was charged to the income statement, of which is part of cost of sales. Good. Now, once we are through with the additional information, we say that we go back to the balance sheet and we'll have to adjust all the items in the balance sheet. Now let's go to the balance sheet. We adjust item one by one. We start with the non-current assets. Number 1, we have PPE. Is it well explained? Have you explained PPE? Good. Intangible assets including goodwill? Not yet. Let's go to the intangible assets. We show the narration or we open T accounts? You want us to open T accounts? To add a narration. Intangible asset, how much is the opening balance? 15? 1560. Then we acquired Mwewe. There was a goodwill, right? Of how much? 40. If you take 1560 plus 40, you're supposed to be adding how much? 1600. But compare that against the closing balance, which is 19. Yeah, 1960. From 1600 to 1960, there is an increment of 360. An increase. What can make your intangible asset to increase? Acquisition. Good. Acquisition. Below the intangible asset, we have investment in associate company. Have you adjusted that? Investment in associate. How much is the opening balance? 400. We say that associate and NCI will be influenced by the income statement. Let's go to the income statement. The income statement under other income. Are you there? Under other income, can you see share of profit in associate company? They made a profit of how much? 160. So we had 400, then they made a profit of 160. You get a total of 560. Then you compare that against the closing balance. How much is the closing balance? 520. There is a decrease of how much? From 560 to 520, there is a decrease of 40. What is 40? Dividend? Dividend? I want to hear that. Is it dividend paid or dividend received? Dividend? It's a reduction. Not that. From 560 to 520, a decrease of 40. That's dividend what? Received. We say that. Actually, it's very simple. We receive from associate. Are you together? We pay to NCI. Are you together? Yeah. We say that we cannot control the associate. So the associate, they usually determine their profit and then they remit the dividend to us. Are you together? So we receive. NCI, we are controlling them. Are you together? So that means we take their profit and then what remains, that's what we distribute back to them. So to NCI, we pay. To NCI, we pay, but from associate, we do what? We receive. Good. Other investment, we have other investment. Is it explained? Yes. We dispose them at a gain. Current asset, what did we say about current asset? Remember we said that inventory, receivable, and payable will go to working capital changes. Then anything under current assets and the bank overdraft gives us cash and cash equivalent. Yes, can you leave that alone? Leave current asset alone. Go to the capital and liabilities. And the capital and liabilities, what do you have? Ordinary share capital. Then we have share premium, revaluation reserve, and retained profit. And also we have NCI. Let's start with the ordinary share capital. That one, I think I need to open an account for you. Let me open it here. Ordinary share capital. How much was the balance brought down? The balance brought down was 1280, and then we have the balance carried down an amount of 1680. When you have the balance brought down, we acquired Mwewe at 360, where we paid through the issue of shares. How many shares did we issue? Share was 80. So that means our ordinary share capital increased, right? So we acquired Mwewe. We issued shares worth 80. There is a change. An increase or a decrease? An increase. An increase of how much? 1680, 1680. You get? 320. Yes. What is that? What can make your ordinary share to increase? Issue of? Yes. In cash. Then we have share premium. Share premium. How much is the opening balance? 1120. Then it increased to? Yeah. 1200 minus 1120. There was an increment of how much? 80. What is that 80? Share premium. The change in share premium is what? Issue of share tapri? Yeah, still it's part of cash. Are you together? Yeah, it's amount of share that we issued in cash. Then we have revaluation reserve. How much was the opening balance? revaluation reserve. The opening balance was 728 plus, remember you revalued an item of plant, and there was a revaluation gain of how much? 80. That was courtesy of note number 3. During the year ended that 1st October 2015, there was a revaluation gain of 80 million attributable to the holding company PPA. So revaluation increased by 80. So 728 plus 80, you get 808. 808, right? Is it 808? Then you compare that against the closing balance. How much is the closing balance? 800. There is a reduction of how much? 8. Can someone think what could be 8? Reduction in revaluation. You are thinking for an answer, eh? Impairment. You cannot revalue something and then being impaired. Eh? Now let me explain something here. Revaluation reserve can only be affected only if there was transfer of reserve. And this transfer of reserve can only affect retained earnings or ordinary share. Yeah, mostly when the company issues share at a bonus, they usually draw the amount from the revaluation. Are you together? Yes, when a company issues share at a bonus worth 20, that means the share capital will have to increase. But in this case, we gave out share for free. Are you together? So what they usually do, that amount comes from within. They transfer from revaluation reserve to ordinary share capital. Are you together? So in this case, there was a decrease of 8. That means of the share we issued, this 320, some of them we issued at a bonus. That's the bonus shares. So that means we never received 320. We received less than that because 8 was through issue of what? Bonus. Eh? So balance brought down, then mueve 80, and then we gave out share at a bonus. What? How much? So now the question is, how much do you receive in cash? The actual cash, you see? 320 minus 8 you get? Yeah, 3. Good. Let's continue. Eh? So you have run a new thing you never knew. Good. We have adjusted ordinary share capital, share premium, revaluation, retained profits. That's the easiest. How much is the opening balance? 960. You compare that against what? 1400. There is an increment of how much? I never said that. Eh? We said that retained earnings is affected by the profit, the income statement. This was the profit at the beginning of the year. That means during the year we made some profit. We add. Can you go to the income statement and you give me profit attributable to the parent? Yeah. You go to the income statement. The profit attributable to the holding company was how much? 1320. 960 plus 1320, you get how much? The retained earnings should be 2280. Now you compare that now against the closing balance. And how much is the closing balance? 1400. There is a reduction of how much? 880, eh? Yeah, reduction of 880. What is that? Yeah, the dividend pay. Yeah. Remember, we pay the dividend from the retained earnings or from the profit for the year. Once we are through with that, we go to NCI. NCI. Let me open an account for you. NCI. How much is the opening balance? Balance brought down. Balance carried down. NCI, the opening balance was 240, and the closing balance was 400. Then, when you have the income, when you have the balance brought down, let's go to the income statement. We have profit for the year attributed to NCI. NCI. We attributed them a profit of how much? 120. Then during the year we acquired Mueve, and we are controlling Mueve 80%. That means our NCI increased by how much? 20%. Are you together? So when you have the balance brought down, you have to increase, because if you acquire a subsidiary, there's an aspect of NCI. So Mueve you take 20%, and the net asset acquired was 400. Is it 80? 80. So add that. That's 440. 440. There is a reduction of 40. Subdeal. There is a reduction of 40. What is that? Dividend? Is it dividend received or dividend paid? That's the dividend paid. Yeah, that's what we attributed back to NCI. NCI, good. Now that's all about equity. Now let's go to the non-current liability. Non-current liability, what do we have? Debentures. How much was the opening balance? We had? Yeah, debenture, the opening balance was 400. How much is the closing balance? You don't compare again is that. Can you go to note number 2? When we are acquiring Mwewe, did we acquire Mwewe with any of the debentures? Yes. So that means we had 400, we acquired Mwewe, and Mwewe came with a debenture of how much? That means our debenture stock increased, right? To 700, and then you compare 720 now against the closing balance. How much is the closing balance for debenture? 1360. From 720 to 1360 is an increment. Debenture increased by how much? 640. What can make your debenture to increase? Yeah, that means we should more debenture. Yeah, it's a cash inflow. Issue of debentures. That's cash inflow. Now let's go to the current liability. Trade payable, that goes to the working capital changes. Accrued expenses, how much was the opening balance? The closing balance is well explained. Bank overdraft goes to where? Yeah, bank overdraft gives us cash and cash equivalent. Then we have taxation. Can I open the account or just explain? I explain. Good. Tax. How much was the opening balance? 880. You add what? Yes. Then tax charge for the year. Let's go to the income statement. To the income statement, the taxation was 1120. When we are acquiring Mwewe, did Mwewe came with any of the taxation? Yes. So you add taxation of 40. So 880, you add 1120, you add 40. What do you get? 20? 2040. Now you compare that against the closing balance. 960. There was a reduction. A reduction of how much? 10? What can make your tax reduce? That's the actual tax pay? Yeah. Tax pay. That's why you're saying that we are converting cash flow statement converts the accrue items from 1120 to cash basis, what we actually paid. Are you through now? Yes. So when you are through now, we prepare what? The cash flow statement. And so let's go to the required. The group statement of cash flow using the indirect method. Sometimes they usually specific. In case they are not specific, use what? Indirect. Yeah. For the year ended that 1st October 2015 in conformity with the requirement of IAS 7. So that was Mawingu group. So Mawingu group. Prepare the consolidated statement of cash flow. For the year ended that 1st October 2015. Start with the operating activities cash flows. What do you start with? Yeah, profit. Profit before tax. Then you go to the adjustments. You see that the non-adjustment, you adjust for non-cash item and non-operating items. Things to do with depreciation, finance cost. Finance cost is not part of operating, it's part of financing activities. Also, loss on disposal Also, gain on disposal, and then any non-operating income. If you want to know any non-operating income, you go to other incomes. Let's go to the other incomes. Anything under other incomes is non-operating. We have share of associate profit. Also, we have investment. Eliminate them. They are not part of operating. And then you factor in the working capital changes. And we see that the working capital what do we consider? Inventory, account receivables, and account payables. And that's how we get our gross operating cash flows. Then you raise what? Good, the amount of tax paid. And that's how we get the net operating cash flow. Remember, I also said that you can deduct tax paid and the interest paid. Are you together? There is no harm. Or alternatively, interest paid, take it to the financing activity. Good. Then you call it in. Then the other part you go to investing activities cash flows. And the investing activities cash flows, we bring the cash proceeds on disposal, cash proceeds on disposal. Number one, it's post what? We disposed PPE. Also, we disposed other investment. You bring the actual amount of cash received. Then we had investment income. We eliminated it from operating. You bring it to part of it. Investment income. In this case, you add it's an inflow. Also, we had dividend received. We are looking at the investment. Sasa, we invest, we receive the dividend in return. So we had dividend received from who? Good. We receive from the associate. Then, how did we acquire? Did we acquire any other asset? Yes, you also factor in. See, acquisition of assets is all about investing, right? Yeah, so we had acquisition of assets. Number one, we acquired PPE. What else? We also acquired intangible assets. Also, we acquired who? We acquired Mwewe subsidiary. And that's how we get the net. So can you take a screenshot of that? So let me just wrap this. And that's how we get the net investing cash flows. Let's call it B. And then lastly, the other part you bring what? Financing activities cash flows. How did we finance the business? Number one, through the issue of what? Yeah, issue of shares. Ordinary share capital. And also we had share. Those share issued at a premium. Also we had issue of what? Yeah, issue of debenture, right? Issue of debentures. What else? Finance costs. Dividend paid. And for the dividend paid, we have the one we paid to ordinary shareholders and the one we paid to NCI. Anything affecting the financing? Let's assume there is none, eh? And that's how we get the net financing cash flows. Let's call it C. Once you have that, now you can factor in the cash and cash equivalents by taking summation of A plus B plus C. Then you add cash and cash equivalent balance brought down and should balance with your cash and cash equivalent balance carried down. Give me the profit before tax. I told you the format is very important when it comes to cash flow. Eh? Yeah, the profit before tax was? Yeah, 2560. Our shillings are in millions. Adjustment, depreciation. How much was the value of the depreciation? Yeah, from our depreciation account we had 400. You add it back because it was non-cash. Finance cost. Let's go to the income statement. Yeah, finance cost was 600. Loss on disposal. Yeah, 104. Gain on disposal. We had a gain of. If it was a gain, that means was included as part of income. Are you together? So, but it's not operating. So you do what? We eliminate 40. Then let's go to other incomes. We had associate profit, which was already included in the profit before tax, but it's not operating. That's why you're eliminating it. How much was it? 160. Investment income, 200. Let's go to the working capital changes. We start with inventory. Let's go to the inventory. Under the inventories, how much was the opening stock? It was 10. Then we acquired who? Mwewe. Inventory of 400. So that means you're supposed to be having 1416, right? Then you compare that against the closing balance. How much was the closing balance? 1400. There is a reduction of how much? 16. What can make your stock to decrease? We sold. What will happen to our cash? Increase. So that's a cash inflow. Good. Let's go to receivables. The opening balance we had 23. 2320. Then you add Mwewe. Mwewe came with the receivable of 160. That means you're supposed to be having 2480. Then you compare 2480 against the closing balance. 29. Increase, decrease? Increase of how much? An increment of 140. Increment of 440. You ask yourself, what can make your debtors increase? Sales, complete the sentence. Sales on credit. Inflow, outflow. So it's an outflow. Let's go to payables. Payable is under current liability. How much is the opening balance? 1392. Mwewe. Yeah, Mwewe came with trade payable of 200. That means you're supposed to be having how much? 1590. You compare 1592 against 16. Increase, decrease? Increase. An increment of how much? 24, eh? 24. What can make your creditors increase? Okay, number one, what gives rise to creditors? Credit purchases. In this case, they have increased. So that means? No, I don't mean inflow or outflow. Eh? We are saying that payable arises from purchase on credit. Are you together? In this case, they have increased. What has happened? We have acquired more on what? On credit. Inflow, outflow? Inflow. If you have bought more on credit, that means we have not yet paid them. We still have the cash. So that's an inflow. Good. Give me the gross operating cash flows. So take 2560 and deduct applicable. You get 2864. Then we raise the tax paid. How much is the tax paid? Just look at it from your screenshot. It's already wrapped. Was it 1080? Good. The actual tax paid was 1080. Now give me the net operating cash flows. 1784. That means from day-to-day operations, we had more inflow than the outflows. Now let's go to the investing. Cash proceed on disposal. Those are free marks. PP was how much? 250. Can you look at note? Go to note number 1. Some item of machinery with an original cost of 680 and net because of the 60 was sold for how much? The actual cash received was 250. Yeah, it's cash proceed on disposal. We received 256. Then number what? Number 4, eh? Number 4. We sold other investment. How much did we receive? 240. Then investment income. Here it is. The one deducted from operating, you add it here, it's part of investing. An amount of 200. Dividend received from associate. Here is the associate. Eh? Was it 40? Yes, we received 40. Then we had in acquisition of asset. We acquired PPE. It is there. An amount of? Yeah, 800. That, and remember, this is an outflow. We should do, is it an inflow? Is it an outflow? We acquired. If we acquire, what will happen to cash? Asset will increase, cash will decrease. Intangible assets. Yes, they are here. Intangible assets. What are the intangible? Yeah. Intangible assets, there was an increment of 360. Then we had subsidiary. It is acquisition of Mwewe net of cash account. An amount of 360. Give me the net. 256, 240. Give me the total. 780. An outflow, right? Yeah, that means we invested more than what we got from those investments. Then let's go to financing activities. Issue of share, ordinary share. Was it 312? 312. Inflow, outflow. In cash flow is very important. We should look even at the sign. Favorable advance, we have to show that. If you just show, for example, 800, you're not showing them is an outflow, automatically is a what? This is a cash flow. Share premium is the share premium. An amount of 80, it's an inflow. Issue of debentures, we have debentures here. An amount of 640, it's an inflow. Finance cost, this one, that's the interest. 600, inflow, outflow. Finance cost, yeah, that's an outflow. Is the interest you paid. Dividends paid to ordinary shareholders from the retained earnings. And dividend paid was an amount of 880. It's an outflow. NCI. Was it 40? Look at your from your screenshot. Was 40, right? Yeah, it was 40. Now give me the net from financing. Four. 488. Negative, Yes. Now, give me the cash and cash equivalent. 5? 512. 512. Now let's determine the cash balance brought down and the cash balance carried. Now let's go to the current assets. Let's go to the current assets. Under the current assets, apart from inventory and receivable, anything under the current asset gives us part of cash and cash equivalent. Yeah, for example, financial asset at fair value, they are part of current asset. That means can be converted to cash later. How much was the opening balance? 0. So when you have the balance down, you write 0. How much is the balance carried down? 400. You add it where you have the balance carried down. Are you together? Then we add, let's go back to the current assets. Below the financial asset, we have cash in hand. Opening balance was, you add it where we have the balance brought down. Balance carried down was, you add it there. Then you minus, let's go to the current liabilities. And the current liability, we have bank overdraft. How much is the opening balance? 780? 784. What about the closing balance? 680. Good. 8 minus 784, you get 776, right? Negative. 416 minus 680. Sorry? 264. 264 negative, eh? Can you take 512? You minus 776. There's a remaining balance of how much? Is it 264, eh? Yeah, it should balance. Good. So we can take a screenshot of that. So we can try another question. Now we do on disposal. Did we do in class May 2015? Confirm we do the question on May 2015 on cash flows. May 2015 question one. We do that. That's what we did in class, right? We did. Eh? Good. What about December 2017? We did that one. Good. So what does we do with? May 2014? We did that one. That means we have done all the questions. I'm asking, not the one you did as an assignment. Sorry? We did only 2 questions. And how comes all those questions you have done? No, I'm not asking about the notes. Eh? I know you have the notes. Eh? I know you already have the notes. Eh? Which one did you do in class? At May 2015. Eh? So we never did December 2017 in class. Eh? Good, let's do that. December 2017, question 3B. Yes? Sorry? So December 2017. December 2017, question 3B. Between that question, there is another question I had shared with the handout I shared. There was for May 2014. I didn't want to do that question. It was a good question on disposal. Actually, what you need to observe is that all the questions in this sitting, they have only set 2 questions from 2010. Have you ever noticed that? That's why mnaniambia zingine tulifanya kwa class zingine kwa handout, because all the questions are the same. Same. It's only the information that changes. So if you understand one, the other question on in case of acquisition will be still the same. Will be the same. Let me look at for that May 2017. Was it a case of acquisition or disposal? Let me see. That one seems to be totally direct. Let me see for the one for 2014. That one is a case of disposal. We had done acquisition, right? Now let's do a disposal. Good. So let's do the one for December 2017. Question 3B, that one is a case of disposal. Now let's start with question 3A. Question 3A. Citing the reason, explain the rationale behind the inclusion of environmental report in a reporting entity annual report. Now, my question is, actually, I don't want you to explain that. What are the content of environmental report? You haven't revised. And I remember I've been repeating this. For the theories part of FR, they'll bring a question on the contents of the reports. Be it a segment report, environmental report, integrated report, environmental report, corporate governance report, and you have them in your handout. Those are the questions that never misses. From the report, they have to bring one of the questions. So that one you know to discuss. You have the notes. Go and revise that. So let's go to part B. Part B, including the content of management report, including also for the auditor's report. There will be one question on the content. The following are the group statement of comprehensive income and the group statement of financial position of Maneno Group of Companies for the financial year ended that 1st October 2016 and that 1st October 2017. So we have the income statement, and then we have the statement of financial position. Additional information, number one. During the year ended that 1st October 2017, depreciation of 240 million was charged in relation to PPE. In this case, we don't have to look for depreciation. It's already given, right? But we can open PPE account. PPE account. If you are given depreciation, that means you open the PPE account at its net book. You don't have to write it at cost, because if you present PPE at cost, you have to open depreciation account. But depreciation account already given the depreciation charge for the year. So present it at net book value. Balance brought down. Balance carried down. How much was the opening balance? 13,500, and the closing was 18,000. Then number one, you know that there was a depreciation. So depreciation you credit, and depreciation of how much? 240. Number two, an item of PPE with a carrying value of 885 was disposed during the year ended that 1st October 2017 for 750 in cash. Was it again a loss? A loss, eh? Yeah, we had loss on disposal of PPE. The book value was 885, but you only realized 700 and so there was a loss of how much? 135. Then since we dispose an item, that means we have to affect our PPE account to show the disposal. An amount of 885. Good, the net book value. Then you told that the loss on disposal is part of cost of sale, so you have to eliminate it. Are you together? It's an operating cost. Number three, on 1st August 2007, the group disposed. So this one is a case of disposal. An 8% owned subsidiary for 1170 million in cash. The subsidiary had the following net assets at the date of disposal. We had PPE, inventory, receivable, cash and bank balances, trade payable, current tax, bank loan. They had PPE, so let's adjust. What will it affect? Yes, we dispose a subsidiary. What do you expect our asset increase or decrease? Decrease. So subsidiary. And how much was the net book value? Yeah, 2025. Then we are told that the subsidiary has been acquired on 1st November 2012 for cash payment of 660 when its net asset had a fair value of 675 million, and then non-controlling interest had a fair value of 150. Good. Are you given? Yeah, actually this one you don't have to do what? We dispose. We say that we need to determine the cash on acquisition of subsidiary. Did I give you a formula on how to get the gain or loss on acquisition of subsidiary? Don't say no. I gave out, right? You take disposal proceed, you raise net asset acquired, you also raise an impaired good. That's how you get gain or loss on disposal. And the motive of preparing the cash flow is to get how much did you receive Are you together? But on this case, you don't have to compute. You already given. Can you read number 3? On 1st August 2017, the group disposed of an 80% owned subsidiary for how much? 1170. So the question is, it's acquisition of subsidiary net of cash acquired. So it's disposal, sorry. Yeah? Disposal of subsidiary net of cash disposed. We dispose the subsidiary for how much? 11. Now, can you look at number 3? Did we dispose it with any cash or bank balance? They had cash at bank? 105. We had or we less? You sold an item for 1170. Are you together? But when you the date of disposal, you disposed it with a cash of 105. Ilikuwa ndani. You? An amount of? Wengine wamechanganyikiwa. Now, if I sell you notes, now let's argue from a practical way. Eh? If I sell to you notes, are you together? And then you pay me 1170. And then upate kwa notes, John Mark alikuwa amesahau ngapi? Because umekuuza na pesa. Hizo notes ulinunua pesa ngapi? Usha recover one offer? Yes, can you give me the net? That's how from that perspective. Eh? 16? 10, 16? Yeah. That's what we received from the disposal of that subsidiary. They paid us 1150 and we paid him 105. Good. Number 4. No, still number 3. The subsidiary had been acquired on 1st November 2015 for cash payment of 660, when the net asset had a fair value of 675 and the non-controlling interest at a fair value of 150. What is that? They want you to determine how much is the good at the date of acquisition. First of all, leave that. Number 5. Number 4. Additional PPE was acquired by the way of lease, amounting to 900 million during the year. So to the PPE, we had acquisition, but this was not in cash. By the means of what? Lease, an amount of 900. Good. Number 5. Dividend paid by the holding company during the year that 1st October 2017 amounted to, you don't have to prepare the retained, you don't have to adjust retained earnings. You already given what they pay. They paid. Land was revalued upward by the holding company by how much? 60 during the year. Revaluation increases the value. Revaluation. An increment of how much? 60. So we need to determine how much do we acquired in cash. Give me the balancing figure. This side is more. Sorry? 29 total, eh? 29. We have 21, 150, 21, 150. 66, 90. So that's the cash acquisition of the asset. And we are through. Now let's go to the balance sheet. We adjust item one by one. The non-current asset, what do we have? PP, is it where adjusted? Goodwill. Is it where adjusted? No. It's not adjusted. How much was the goodwill? Can you compute for me the goodwill? Now this is what you do. How much was the opening balance? 390. Are you together? We minus. We disposed a subsidiary, right? And you are told that how much was the value of the date of acquisition, but you're not told about its impairment. So, if we dispose that subsidiary, that means also eliminate its goodwill. Are you together? That's what we call the goodwill disposal. Can you compute for me the goodwill? It's very easy. Take the purchase. How much do we pay for that subsidiary via the net asset acquired? Give me that. We're getting a goodwill of how much? 30. Yeah, now let's be here. Let's number 3. The subsidiary had been acquired on 1st November 2012 at a cash payment of how much? 660. When the net asset had a fair value of? Are you together? And then non-controlling interest was how much? You can get goodwill. Goodwill on acquisition of that subsidiary. Goodwill on acquisition. You have 2 ways you can compute that. You take how much was the purchase consideration? 660. You add the NCI fair value. How much was it? 150. You raise the net asset. How much was the net asset? Well, the net asset was 670. 675. 130. Or alternatively, the purchase consideration was 660. You raise the net asset up, and the value of net asset was how much? 675. Are you together? But of this 675, you're only controlling. You take 80% of that. Give me the goodwill. You get 120, but you are given the fair value of NCI. So that means to get the goodwill, use the full goodwill method. You add NCI. Yeah, how much is the fair value of the goodwill of the NCI? The fair value of the NCI was 150. You compare it against the net asset. The net asset was 665, 675. We are controlling 80. How much was the NCI? 20. Are you together? How much is this? It's 135. It's 135, but the fair value was 150. So the difference between the two is what we call the goodwill on NCI, an amount of 15. Kwa hivyo ilikuwa ngapi? 135. Hatuko mambo ya impairment. Are you together? So let's adjust the goodwill. How much was the opening balance? 390. But during the year we disposed of subsidiary. Kama tumedispose, si goodwill yako aliana nayo. Unatoa ngapi? 135. Yabakia ngapi? 250. Then you compare that against the closing balance. How much is the closing balance? Is it 255? Yes. Is it well explained? Good. Then we have investment in associate. Investment in associate. How much is the opening balance? It was 400 and a income statement and other incomes. At other incomes, to the income statement, we have share of profit after tax in associate. You add or you raise? Hey, you add or you raise? You add. They made a profit of 144. So what do you get? 420, you add 144? 564. Then you compare that against the investment in associate, balance carried down, which is 510. It may decrease na ngapi? 50? 54. What is that 54? Dividend? Received. Good. Let's go to the current assets. Tunaguza current assets. Inventory, receivable, working capital, right? Financial asset at fair value, cash at bank balances to cash and cash equivalent. Are you together? Good. Tuende kwa equity. We have what? Ordinary? Yeah, ordinary share capital. How much is the opening balance? 4,500. Do you have any issue of share? Hatukuwa nayo. Kulikuwa nayo? Hapana. Compare that against the closing. Closing ni ngapi? Ime increase na ngapi? What is 15? Issue of share? Hiyo ni pesa iliingia. Then we have share premium. Tulianza na ngapi? 0. Tumefunga na ngapi? 900. Kumaanisha ime increase na ngapi? That's the issue of share income in cash at a premium. So in short, during the year, we should share with how much? 2,400. Right together. But remember, I said that at a published, ordinary share capital will be recognized at par value with any balance reported at a share premium. Share premium. Good. Then after that, we have revaluation reserve. How much is revaluation reserve? 0. Tukafunga na ngapi? Lipa kitu hapo? Hapana, we'll come back to that. So we'll come back to that. Let's go to retained profit. Do you have to adjust retained profit? What is the motive of adjusting retained profit? To determine the dividend. But in this case, we have to compute. You already given the dividend paid. Note number 5. Dividend paid by the holding company during the year ended that 1st October 2017 amounted to 120. You don't have to adjust that. Then we have what? Can you see NCI? Shareholders fund attributable to NCI. Now let's try to open that account. Not us. Try to open that account for NCI. I want to determine the amount of dividend paid to NCI. And I can give you a hint. There is balance brought and there is balance carried. Now how much is the opening balance? 525, and the closing balance is 220. Yeah, let's try to think. Let's try to think what else affect the NCI. Anza kuchora. Yes, I want everyone to prepare that. Prepare that. And then you hear your views on your answer. You know, for me, I already have the answer. What are you getting? You mean that's how it will take long to adjust them in an exam? Can someone volunteer to give me the amount of dividend? Why are you getting how much? 135. 165, 120. Good. Now let's be here. Let's not waste time. Now we have the opening balance, we have the closing balance, right? What else affect the NCI? Income statement, debit, credit. Yeah, well, you have the balance go down. To the income statement, we have the profit for the year attributable to NCI. How much was it? 70? 75. Then during the year, we dispose a subsidiary, right? We are controlling the subsidiary 80%. What do you expect to NCI? Increase or decrease? What will happen to? Increase or decrease? It will decrease. So we disposed of a subsidiary and we are controlling it 80%. That means NCI is 20% of the net asset disposed. How much was the net asset disposed? It was 1,200. Is that 240? Is that 240? Yes. Then, now let's be here. There was goodwill on acquisition of a subsidiary. And that's why I said, or you bring the parent goodwill, and then there was NCI goodwill. Yangapi? Kama ameenda semena na goodwill yake. Goodwill. Yangapi? So once you have that, then we can be able to determine how much dividend did we pay. This is 600, right? 600. There is a reduction of how much? 120. That's our dividend paid. That's the dividend we paid back to NCI. Yeah, good. Now let's go to the non-current liabilities. Non-current liabilities. What do we have? Bank loan. Eh? Let's adjust bank loans. How much is the opening balance? 3,000, right? Let's go to the disposal. Did you dispose any bank loan? Yes. How much? You minus 600. That means you are supposed to be having 2,400. So that's 2,400, right? Then you compare that against the closing balance of 42. Wachani kuchoka. What do you get? 18. Increase, decrease. Increase. What can make your bank loan to increase? Borrowed. Eh? You are trying now to show me what we call the mental fatigue. Eh? Na hakuna kitu umesoma. Kuna kitu umesoma kweli? You see, I'm the one who is doing all the thinking. Eh? Yeah, that's the loan borrowed. Then we have obligation under finance lease. Now, finance lease, if we have an item on lease, it's both our current liabilities as well as a current liability. Are we together? So let me open for you a T account. Lease obligation. It's a liability. And you have said that a lease obligation is both a current and an non-current liability. So let's start with the balance brought down. Balance carried down. Let's start with the one then non-current liability. Obligation under finance lease. How much was the opening balance? 135. And how much was the closing balance? 630. Can you go to the current liability? Let's go to the current liability. Both of them, they are liability. Yeah? So just combine them. And the current liability, we have obligation under finance lease. How much is the opening balance? Yeah, that's what you're supposed to pay in the next one financial year. Non-current is what will take more than 1 year. What about the closing balance? 45. Are you okay up to that point? Then when you have the balance brought down, can you look at PP account? During the year, we acquired an item through the means of finance. That's what we are told. That was courtesy of note number. Yeah, number 4. Additional PP was acquired by way of lease. We never paid cash. We leased it out. So you expect your lease to increase. So PP was how much? 900. So my question is 900 plus 165, you get 11? Is that 10 or 11? 10, 16? You compare against 675. There is a reduction. Are you together? Of how much? 390. What can make your finances to reduce? Yeah, that's what we call the lease rental paid. Yeah, lease rental paid. Why would you take this? Yeah, go to financing activities, cash flows. Good. We go back to the balance sheet. So we are through with the operation under finances. Then below non-current liability, we have what? Deferred? We say that whenever you have a deferred tax, you don't have to open a deferred tax account. You open what? Tax account. Eh? Yeah. Because both deferred tax and the current tax, both of them, they are tax. And both of them, they are liability. So balance brought down, balance carried down. We start with the deferred tax. How much is the opening balance? 915. How much is the closing balance? 1020. Then let's go to the current liability. We must be having the current liability, current tax. Can you see the current tax? Yangapi? 63.84. When you have the balance brought down, let's go to the income statement. There was tax charge for the year. So to the income statement, income tax expense was 144. Then we disposed of a subsidiary. Did you dispose with any tax? Yes. Current tax of? If we dispose, what happened? Anatolea mzigo, si ni kweli? Good. So that means we disposed a subsidiary with a tax of how much? 15. Now we want to determine how much tax did we pay during the year. Three. That's the tax paid. We only paid 3. Good. So you are doing the non-current liability. Now let's go to the current liabilities. Under the current liabilities, we have trade payable. That one will go to working capital. Accrued interest. Have you adjusted? No. Accrued interest. It's a liability. How much was the opening balance? 20. It's accrued interest. That means it's an interest that we have not paid both by the beginning of the year and at the end of the year. You take the one we had not paid by the beginning of the year. Let's go to the income statement. We have the finance charge for the year. How much was the finance cost? 450. So that means it's 450 plus 27, you get 470. 477. Then you compare again. It's how much is the closing balance? 20. It has reduced to 21. So that means how much did we pay? 440? 456. What is that? Yeah, that's the interest paid, 456. Interest paid. Then below the accrued interest, we have the current tax. Is it adjusted? Operation under finance lease, is it adjusted? Yes. Let's go to the required. Group statement of cash flow in accordance with IAS 7, statement of cash flow for the year that passed December 20. And they were silent about the method to use. Which method do you want us to use? Both. Direct. Good. Maneno group. Consolidated statement of cash flows for the year ended. When is the year ending? 31st October 2017. We said which method? Good. Indirect. So under indirect method, operating activities, cash flows. Let me flow with those who remember the format. Yes, profit before. Then we go to the adjustment. One, we have depreciation. Depreciation. Finance cost. Yeah, loss on disposal. Yeah, if you have cramped, you can write loss on gain. But what we have done, we have both. We had only what? Loss on disposal. Do you have any gain? Then, yeah, then once you have that, you go to income statement. Anything under other income, it's not an operation. Can you go to the income statement? We have gain on sale of subsidiary. Yeah, gain on sale of subsidiary. Also, you have associate profit. Actually, up to that point, nothing you need to compute. Those are free months. Or do you have something you need to compute there? That's something straightforward. Even you don't have to compute. You just write it here. Loss on disposal, just do the computation there. Once you have that, you go to working capital. Yeah, working capital changes. What do we factor? Inventory, receivables, and this one you don't require to open any account. It's just looking at the changes. You don't have even to open all these accounts. Once you have that, you get what? Gross operating cash flows. Once you have that, you get what? Yeah, tax paid, so that you get what? Net operating cash flows. I call it. From there, we go to investing activities cash flows. How did we invest it? Number one, start with the cash proceed on disposal, cash proceeds on disposal. What else? We didn't have any investment income, but we received income from who? Associate. Or we didn't have associate. So you have associate. Good. Dividend received from associate. Or else, then we have acquisition. Also, we had another cash received on disposal of who? Subsidiary. Yeah, cash proceed on disposal. Actually, here you're supposed to show both from the PPE and the one we got from the associate. Then we acquired asset acquisition of PPE. You only acquired PPE, right? In cash, nothing else. You never acquired any other assets. And that's how you get net investing cash flows. Let's call it B. Take a screenshot, I wrap this. Once we have the investing, then we go to financing activities, cash flows. So on the financing activities, cash flows, how do we finance the business? We had issue of what? Issue of shares from both ordinary share capital and the share premium. We had finance risk, or lease, finance risk, rentals paid. Also, we had dividend. We paid number one to ordinary shareholders as well as to NCI. We issued any loan? Loan borrowed. Do we have any loan? Loan borrowed. And then we have interest paid. Interest paid, it's the part of finance cost. And that's how you get your net financing cash flows. Once you have that, we get our cash and cash. Yeah, cash and cash equivalents. A plus B plus Then you add cash balance brought. Should balance with your cash balance, correct? Yes, let me use my own approach. Let's start with the cash balances. Let's start with cash balances. Let's go to the current assets, What do we have? We have financial asset at fair value. The opening balance was? And the closing balance was? 135. You add. You also had cash at bank balances. The opening balance was? 390 and the closing balance was? 510. Then we minus bank overdraft. Let's go to the current liabilities. Did you have any bank balance? We didn't have any bank overdraft, right? Good. So you minus 0. 90 plus 390 you get 420. 135 plus 510 you get 645, right? 640. Yes, and you get a ticket way to get another free mark. Can someone give me A plus B plus C? 220? Correct. If you take X plus 420, you should get 640. Those are 3 marks, right? Then you come to issue of share, ordinary share capital. I don't want to look at the workings. I just want to look at the past paper. How much was the ordinary share capital? The opening was 45. The closing is how much? There is an increment of how much? 1,500. Let's go to the share premium. How much was the opening? It increased by how much? 900. Finances, that one you have to work for it. Dividend paid, we already given. Let's go to note number 5. Dividend paid by the holding company during the amount of how much? 120. But it's an outflow. Loan borrowed. Let's go to the loan borrowed. Then current liability. How much is the opening? 3,000 minus, yeah, the one you disposed, 600. You get 20? 24. You compare 24 against 40? 42. An increment of how much? 1,800. That's a cash inflow. Interest paid or finance cost paid, even that one is totally direct. That one we assume you can fail. Okay. Now let's be here. Profit before tax. Profit before tax was 699. Adjustment, depreciation. Note number 1. During the year, depreciation was how much? 240. Finance cost. Go to the income statement. How much was it? 450. Loss on disposal. Number 2. An item of plant with the carrying amount of 885 was disposed during the year at how much? 750, right? So there was a loss of how much? 135. Let's go to other incomes. We have gain on sale of subsidiary amount of itoe hapo kabisa. Associate profit 144. To hapo kabisa. Let's go to working capital changes. Inventory. How much was the opening balance? 30. Then we are not passing. We disposed, right? If we dispose, you deduct how much? 90. So that means you're supposed to be having 3,000. You compare that against the closing of that 900. An increment of how much? Yeah, what can make your inventory to increase? We acquired more. An outflow. Let's go to account receivables. How much was the opening balance? That 120 you minus. We disposed 130. That means we have 2985, right? You compare that against the closing of that one. That 120. Increase, decrease. This was 29 to that one. An increase of how much? 130. What can make your debtors to increase? Sell on? Inflow, outflow? out. They never paid, right? Let's go to account payables. Trade payables, the opening was 1785 you minus. Yeah, note number 3, trade payable disposed was? How much is the balance? 1240? Yeah, you compare 1245 against 2950 is an increment. An increase of how much? 17? 10. What can make your creditors increase? Purchase on credit? Inflow, outflow? Inflow. Tax paid. That one is that free? That one is free, Max. Opening plus charge for the year. We acquired, we disposed. Then you compare against the closing. But that's me, eh? So let me respect your opinion. It's not free. Cash proceed or disposal of PPE. Tuliza pesa ngapi? Just read that note number 1. Number 2. An item of PPE with a carrying value of was disposed at how much? Disposal of not associate, it was subsidiary. Eh? Cash proceed on disposal on subsidiary. That's it's a free mark. Eh? It's all about determining whether to add, whether to. Yeah, because in this case, you are given the amount to dispose. Can we go back there? Number 3. On 1st August 2017, the group disposed an 80% owned subsidiary for how much? 11. Just remember that I say that you should show that amount net of cash disposed or acquired. Are you together? Yes. And number 3, did you dispose with any cash? Yes. Just remember the issue of notes. Eh? You minus 1 over. And you are getting how much? 1060? 1065, which is an inflow. Dividend received from associate. That one you can get. How do you get associate? Opening plus profit, you minus closing. Is it a free or not free mark? It's a free mark. You take the opening balance. We say that associate affected by the income statement. Even something you can do with the calculator, it's not a must you have to write. You look at the opening, how much was the profit during the year? You compare against the closing. How much is that? Investment in associate was for 20. Then Rangaria hapo juu, they made a profit of 144. And then you compare that against the closing balance of 510. There's a reduction of how much? 50? 54. That's a free mark. Eh? 54. Acquisition of PPE, that one you have to sweat. Eh? Yeah. Good. So how many marks can you get without doing any workings? How many marks? 18. This question was carrying how many marks? Sorry, Isha Kitabo. Without doing any other one. So Cashflow just master the changes. Just know how to argue the changes. Nothing else. And then the format. Format is very important. You bring something on financing and investing, that's very wrong. Are you together? Good. So can you give me now the gross operating cash flow? Now let's work as good student. Eh? 699, and just give me the gross. Let's try to hurry up. I want to show you even work this solution with using the direct method. $19.35. Then you deduct the amount of tax paid. How much was the amount of tax paid? Was it 3? Was 3, eh? 3. They still use calculator. 1930. Now let's go to the investing. Cash flow, that one you have that. Acquisition of PP. Now you go to the PP. We had an amount of 66. 90, 66, 90, but this one is a what? Is it okay? It's not okay. Can someone realize for me the mistake and then I'll adjust? Can someone erase the finance risk? Can someone troubleshoot? Good. Let's continue here. How much was the finance lease paid? Not which one? Good. This is an outflow. Kindly in cash flow, master those inflow out. If you write 66.9, that's very wrong. That's how you have to show them was a what? An outflow. Can you give me the net? 48, 21 negative. We have the issue of share from ordinary share capital, share premium, finance lease. How much was it? Just look for your, from your screenshot. What's 390? Eh? Yeah, 390, and that one we paid. It's an outflow. Dividend paid to ordinary shareholder you already given. What about NCI? The one you struggled to compute. Was it 120? Yes, 120. Loan is okay. Interest paid or finance costs. Let's look from your screenshot. We had already computed that. We took the opening plus the finance cost for the year, Jack the closing. 450? 456. Now, can you give me the net financing cash flow? No, this one is an interest paid, eh? So it should be. Yeah, you deduct that. That one? 14. Positive, negative? Positive. Now, can you try to take A plus B plus C? It's 220. So, can I show you on how to present using the direct method? Good. So, if you are to use the direct method, is Mawigu group. Consolidated statement of cash flows for the year ended. When is the year ending? That 1st October 2017. Operating activities cash flows. What do you bring? Cash received. You deduct what? And that's how you get gross operating cash flows. It's up to this point. Then from there, you deduct what? Tax paid. And that's how you get the net operating cash flows. And that's how you get your 8. So investing and financing, that one does not change. Eh? Just copy the way it is. So how do we get the cash received? You open income statement. Debtors account. So how do you prepare the debtors account? So to get the cash received, you open the debtors or account receivables account. Yeah, you have the balance brought down and we have the balance carried. Yeah, debtors. How much is the opening balance? Yeah, for the debtors, we had that one. And the closing balance? That one? 20. Then we have the balance brought down. I mean, we disposed who? A subsidiary. Disposal you eliminate. Eh? Subsidiary disposed. At an amount receivable of how much? 135. Then when you have the balance brought down, what increases the debtors? Credit sales, right? So you factor in your sales. Sales is the same as revenue. Let's go to the income statement. How much was your revenue? 3075. This one you get 6190. 61.95, 61.95. There is a reduction to that 255. That deduction is the cash received. 29.40. So the cash received 29. How do we get the amount of cash paid? We say that you open two accounts. Which one and which one? Accounts payable and inventory account. I told you that the easier way is to open them as one. Let's start with inventory. Inventory is an asset. That means its balance brought down. Be on the debit side, balance carried down. How much was the opening balance for inventory? That 90, and the closing balance is that 9. Then we disposed a subsidiary. What will happen to inventory? We reduce. So disposal. How much was the amount disposed? 90. Are you okay up to that point? Now let's factor in payable. Payable is a liability, so we'll be having balance brought down, balance carried down. Payables, how much is the opening balance? 1785, and the closing balance is 2950. Then we dispose subsidiary. When you dispose, that means we eliminate that. An amount of 540. Then we say that from the debtors account, we debited the sales. So from the payable and the inventory, on the credit side, you bring operating expenses. And we say that under operating expenses, we have cost of sale, selling administrative, but you don't factor in the finance cost. The finance cost. Let's go to the income statement. Cost of sales, how much is it? 1417. And other expenses, we have what? Distribution expenses, an amount of 240. Then we have admin expenses of 480. Don't factor in the finance cost. Finance cost is part of financing activities, right? But of these operating expenses, we have some non-cash items which were included. For example, you are told note number 1. Note number, yes. During the year that 1st October 2017, depreciation of 240 was charged in relation of PP. That means depreciation is part of either cost of sale or admin or distribute, but it's non-cash. So what do you do? You eliminate. So depreciation, an amount of 240. Then what else? Finance cost, no. We have loss on disposal. Loss on disposal, that means what is reported as part of an expense. That means it's either part of cost of sale, distribution, or admin, but it's an operating. You eliminated loss on disposal. How much was it? 130? 135. In case it was a gain, you bring it this side. Gain on disposal. Nothing else. Do you have anything else? You want to look at the depreciation, impairment, and then gain or loss on disposal. So now we can be able to determine the amount of cash paid. Keep, can you do the necessary thing? Close that. Good. Yeah, you have to add this, including that 9. Make sure you factor in the closing balance of that 9. Is that the total of the balancing? $10? 10.05. So for the cash paid is 10.05. So let's deduct that. 19.35. Is it the same with our gross operating cash flows? Yes, 19.35. Then you can less your tax paid. of 3, and that's how you get 1930. Then from there you can just copy. Haijaishia hapo. You copy the investing activities as well as financing activities. Are you okay now? Good. Take a screenshot of that. Hey, and that was the last class.